10 things to consider before investing in real estate. Investing in real estate can be both profitable and enjoyable. Whether you are hand-picking your primary residence or investing in rental property, a lot of money can be made by savvy investors. However, as with any investment, there are plenty of risks involved in buying real estate. 1. Your purchase is highly leveraged. Most people think of housing investments as safe, consistent, and reliable, but in reality, buying a property is a highly leveraged purchase. The traditional, conservative recommendation to put down 20% when you buy a property means that you're borrowing 80% of the value of your property. If your property's price drops by 20%, it doesn't mean that you've lost 20% of your investment, it means you've lost 100%. For example, if you buy a $100,000 house and put down $20,000, you owe the remaining $80,000. If that house drops in value by 20% to $80,000, you could sell it and pay off your mortgage, but you've lost all of your initial $20,000 investment. Some loans are even more lenient in terms of a down payment. FNMA or Fannie Mae offers a 3% down mortgage option, and the VA or Veterans Administration offers a 0% down home mortgage. In these cases, you're even more leveraged. True, leverage works both ways, and you stand to gain a similar amount if your home appreciates. However, many people don't understand how putting down a small amount of money magnifies their leverage. 2. Supply is limited. The available supply of houses crashed during the pandemic, driving prices high and limiting choices for buyers. Although things have loosened up a bit, the housing supply is still quite tight. Even though the total housing inventory is up about 15% over 1 year ago, inventory levels are still at historic lows. With a limited housing supply, it puts you in the position of either buying something you don't really like and paying a premium price for it, or waiting for a better opportunity to get what you want. It's never a good idea to feel rushed into an investment, so don't be afraid to step back and think twice before you invest in this real estate market. 3. Pricing is a guessing game. Unlike the stock market, where buyers and sellers actively provide real-time market prices, real estate pricing is opaque. Although you can use the sales transactions of similar properties in your neighborhood, known as comps, to estimate the value of your home, the real value is what a buyer will pay for it. This can be a complete unknown until you actually put your property on the market. Online real estate services provider Zillow is often used as a reference for home prices, but actual sales can be far above or below the listing price. 4. Prices remain high. According to data from the St. Louis Fed, the median price of a home sold in the U.S. jumped from $423,600 in 4th quarter 2021 to $467,700 in 4th quarter 2022. While there are reports of some market softening in 2023, thanks to high inflation and mortgage rates, there has not yet been a wholesale sell-off in housing prices. Pricing, of course, is regional, and it can vary from national trends in different markets. But if you were to jump into the housing market now, you'd be buying at near peak levels, in a macro environment in which many believe a recession is coming. In fact, if you're a believer that prices generally regress to the mean, it might be a good time to wait out this price explosion, which some observers are referring to as a bubble. 5. You may not get a deduction. One of the often touted benefits of buying a primary residence is that you can deduct your mortgage interest on your taxes. However, this only applies to taxpayers who itemize their tax deductions. With the near doubling of the standard deduction in 2018, the standard deduction became quite generous, to the point that only about 10% of taxpayers itemized their deductions in that year. For tax year 2023, the standard deduction for joint filers is a whopping $27,700. What that means is nowadays you'll need a pretty substantial mortgage if you plan on deducting your mortgage interest. 6. Real estate is not liquid. Although real estate can provide solid long-term returns, it is one of the least liquid investment markets there is. While you can liquidate a stock in a nanosecond just by entering a trade with an online broker, real estate typically takes weeks or months to sell. If you have an urgent need to pull out the money you've invested in real estate, you may have to lower your price to fire sale levels to move things along more rapidly. In most cases, this makes real estate an inappropriate investment for short-term investors. 7. Real estate carries extra costs. Buying real estate isn't as simple as agreeing on a price and handing over the money. There are numerous additional costs involved in real estate transactions that make it hard to profit over the short term. For example, in addition to the purchase price of a property, you'll have to pay a host of additional fees, from title insurance and property inspection fees to property taxes and lender costs. All told, the final cost of your transaction may be 5% or more than the sale price, and that's before you invest any additional money to change, upgrade, or repair the property. If you plan to sell the property in the future, your closing costs will likely be even more, as they average about 8% to 10% of the value of the transaction. 8. Returns are market-specific. Remember the old adage that the three most important things in real estate are location, location, location? If you're an investor, this is a pretty accurate statement. This means that you can't simply buy random real estate thinking that real estate always pays off. Just as if you're buying a stock, you'll have to analyze the property you're considering buying to determine if it has a chance to outperform. Everything from politics to weather patterns, demography, school districts, and crime statistics go into determining what makes a good real estate investment, and it can take a professional's eye to factor in all of the relevant elements. 9. Inflation is a factor. It's true that inflation often cools housing prices by skyrocketing mortgage costs and thereby damping demand. But so far in 2023, these forces haven't dramatically dragged down housing prices. Beyond this dynamic, however, as a buyer you'll have to factor in just how much more inflation is going to make your real estate investment cost. After your initial purchase, everything you buy for your property, from upgrades to needed repairs, will likely cost you significantly more than even just 1 or 2 years ago. 10. Investment properties require a lot of work. If you're intending to invest in real estate for the rental income, you should know going in that it's not as easy as it may sound. Yes, if you can consistently rent your property, you can earn more than your mortgage payment, but the entire process is much more involved. For starters, you've got to find a tenant who's willing to pay the rent you require. Once your tenant is in, you're on the hook for maintenance, repairs, and any complaints your renter may have, which often seem to come in the middle of the night. If you've got an unruly tenant or one who consistently pays the rent late, you may find that it's more difficult than you imagine to get them out. Investment properties for rental income can be lucrative, but all the work involved means they are not a good fit for everyone. Be sure to like and subscribe to catch the next video from New Day Property Redevelopers.